The webinar will begin in 1 minute. Welcome everyone, and thanks for joining us for today's webinar, Tax Aspects of Chronic and Terminal Illness Acceleration. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. His latest book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, which was written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, and life insurance background and his practical experience for today's webinar. And here he is.
Thank you very much, Jennifer, and welcome everyone. Glad you've joined us today. We're going to talk about the taxation of chronic and terminal illness accelerations in about 15 minutes, and so we're not going to do it a great justice, but we'll at least touch on some of the finer points and maybe talk about a couple of the ambiguities. But before we get into that too deeply, let's go ahead and decide what we're going to talk about next month. Your three choices are the C Corporation tax advantage, the second choice is captive insurance companies get a win, and the third choice is HSAs in a nutshell, and that's going to be on Wednesday, July 7th. Let's go ahead and open the poll, Jennifer, if we will, and give everybody who's on the call a chance to vote on what the topic will be for next month. I'll give you about 30 seconds to go ahead and vote in the poll. Give you a few more seconds. A couple people haven't voted yet. All right, let's go ahead and close the poll. And the poll, the topic for next month is going to be the C Corporation tax advantage. Thanks all of you for participating in that, and thanks for giving us your input on the webinars. Reminder, it's Wednesday, July. Well, look at me. It's not. Yeah, it is Wednesday, July 7th, after the 4th of July holiday. I got my months mixed up. So there we go. Join us then for the next free webinar. So let's go ahead and talk about the accelerations on life insurance policies. And the question that Jennifer and I get a whole bunch is, you know, my client owns a life insurance policy that has an acceleration feature for chronic and terminal illness. And the question is, will the benefit be income tax free? A lot of times the clients or producers are looking at marketing pieces that the companies produce that talk about how the acceleration may be income tax free. And the the folks are wondering about, what's the difference between for certain and may. And we'll talk about that in some detail. But I think to get started, we have to talk about the basics, which starts with Code Section 101, which is the code section that says that the death benefits paid under a life insurance policy are usually income tax free. There was a new code section added years ago, Section 101G, that specifically discussed how certain kinds of accelerations of death benefits are going to be treated for income tax purposes. And it specifically delineated two kinds of accelerations that would be treated as a tax-free death benefit. And the first kind is a terminally ill acceleration. If someone's terminally ill and they accelerate the death benefit, then the amount that they receive is going to be income tax free. And then the second kind of acceleration would an amount received on the life of somebody who is chronically ill is a tax-free death benefit. And so those things seem pretty clear, except for what are the definitions of terminally ill or chronically ill? Well, for terminally ill, it means somebody who's been certified by a doctor as having an illness or physical condition that's going to result in death within 2 years. Well, inevitably, somebody asks the question, well, what if somebody survives for more than 2 years? Is the IRS going to retroactively tax what it is that they received as an acceleration under the life policy? And the answer is no. It's gotta be somebody who gets money after being certified that they're not expected to live for more than 2 years and not expected to live by a doctor. If they actually live longer, good for them. It doesn't affect the tax-free nature of the acceleration. So that's somebody who's terminally ill. Now, chronically ill has a longer definition, but it's substantially similar to the definition that's used for qualified long-term care products. That is, somebody's not able to do at least 2 ADLs, activities of daily living, or they've got a cognitive impairment that doesn't allow them to be able to act on their own. And so if they meet either one of those standards, inability to do 2 out of 6 ADLs or cognitive impairment, severe cognitive impairment, they are chronically ill, and any acceleration under a life policy to the extent of certain benefits, and we'll talk about the limit of those benefits in a minute, are going to be tax-free. So there are companion questions that come up in connection with the acceleration questions. And the companion questions that we often get asked are these. The first one is, well, carriers sometimes have critical illness riders in addition to chronic or terminal illness features. And so the question is, well, are the benefits paid under those kinds of riders also tax-free? What happens for terminal or chronic illness accelerations if there's a third-party owner of the life policy? Are the benefits still income tax-free? How are annuities with enhancement features for certain kinds of conditions, chronic illness, critical illness, terminal illness, how are they treated for tax purposes? And then almost always somebody asks about tax deductions or other benefits that might be available in connection with certain kinds of products and certain kinds of features. And we'll at least touch on those in some of our time here. So let's talk first of all about the critical illness rider feature. Remember, I talked about Code Section 101 and specifically Code Section 101G with regard to terminal illness and chronic illness. There is no feature or there is no provision in Section 101 about critical illness. That's the bad news. But the good news is that there is another code section that seems to indicate that critical illness rider benefit is going to be income tax free, and that's Revenue Code Section 104. The code section says that any amounts received under accident or health insurance, that's A3 on what's on your screen, is going to be tax-free. The whatever's paid under that is not included in income. Well, are we sure that a critical illness rider benefit is going to be considered to be an amount received through accident or health insurance? And the answer is a soft yes, because there is a 2006 private letter ruling that specifically ruled for that taxpayer that benefits received under a critical illness rider was going to be excluded from income under Code Section 104A3 if the premium was paid with after-tax contributions. And so it's not quite as good as the information or the support that we've got for tax-free treatment for chronic illness or terminal illness, but it is pretty good. The IRS said in a private letter ruling that critical illness rider benefit was going to be income tax free. That was that particular critical illness rider and that particular taxpayer for whom the logic could be applied. But this is how the IRS looked at it. Critical illness riders, while they may have different features, they are not necessarily so wildly different that folks couldn't decide that this private letter ruling will help protect them against the possibility of taxation of amounts paid under a rider. So our answer here is a soft yes, that the critical illness rider feature, amounts paid under the critical illness rider, would be income tax free under Section 104A of the Internal Revenue Code. So let's go back to chronic and terminal illness. And let's talk about how do things work out if a third party owns the life insurance policy. And we wrote a blog post back in, it's hard for me to believe this, but back in 2011, dealing with this. So, it's a 10-year-old blog post, but I think the logic still applies. We've got a situation which gets asked about quite frequently, where somebody is buying a life insurance policy and wants it to be owned by an ILIT. And the question is, under those circumstances, will the benefits paid under the chronic illness rider be income tax free? And I think before you get to the income tax question, you got to analyze the situation a little bit more deeply. And that's why we came up with the answer. It's probably not good to combine ILIT ownership where the insured wants access to the chronic illness rider. And the analysis is if the insured can't do 2 out of 6 ADLs, access to the acceleration or to the rider benefits are tax-free. The limit in 2011 when we wrote this was $300 a day. It's $400 a day now, or actual long-term care expenses if they are greater. That's the amount that could be tax-free under a chronic illness rider or acceleration. So that hasn't changed. But the question of whether it makes sense to have an acceleration feature relied on in an ILIT situation has more to do with the reason for an irrevocable trust and how it has to be put together. So if for a trust to be effective for estate tax purposes, the insured's got to have no right to reach in and pull money out of the trust his own self. And if the trustee is permitted to pay for expenses incurred by the insured, that's a problem too. That screws up the estate tax objective. And so if the insured is unable to do 2 out of 6 ADLs, the insured can't force the trustee to do an acceleration for chronic illness, nor can the insured force a distribution of money that's in the trust, even if an acceleration is done for the insured's benefit. However, if the trustee decides that it's prudent because the insured can't do 2 out of 6 ADLs to do a policy death benefit acceleration, the trustee could do that and could make a distribution of that acceleration, assuming the trust has the the right language to spouse or other beneficiaries of the irrevocable life insurance trust. Now, there are two possible drawbacks to that. First of all, there can't be any legal obligation between the beneficiaries and the insured to force them to do that, because that would screw up the purpose of the irrevocable trust. And then the second thing is that we're not sure whether the benefits paid to the trust under those circumstances are going to be taxable or not. They're probably going to be tax-free, and we'll talk about that in a second, but we're not sure whether the benefit's going to be taxable. Everything in Code Section 101G seems to contemplate that the insured is the owner of the contract when they talk about the tax-free nature of the death benefit, except for one other thing, which we'll also talk about in a minute. But in general, because of the tax uncertainty and also because of the insured's inability to have direct access to the acceleration, it's why we recommend that, or it's why we say that it's not really a good idea usually to combine ILIT ownership when the insured wants access to the chronic illness rider benefit. And for those of you who are really interested, our blog post is posted here in case you want to double check on me. But sometimes the question comes up, well, what about a business context? And the answer is that there's a specific portion of Code Section 101G that deals with business-owned life insurance. And it specifically says where a business is an owner of the life policy, the acceleration is not income tax free. And so that, that's an important thing to know. There is a specific exception in the code. And so it's clear that with a business-owned policy, the benefit under an acceleration is going to be taxable to the extent of any, just like any other distribution from the policy. And I think you can make an argument that because Congress and the President joined together to specifically say that accelerations for business-owned policies are taxable, if it's a third-party personal owner, I think you can infer that it's tax-free because Congress and the President didn't think enough of the possibility of a family member owning a policy to say that under those circumstances, the benefit's going to be taxable. Now, that's a stretch based on logic. The IRS hasn't said it, but it's why we think that probably the benefit paid to a family member owned under a family member owned acceleration or an ILIT owned acceleration is probably tax-free. And sometimes people ask the question, well, how is the IRS ever going to know about this? And the answer is the carrier is actually required to report to the IRS when they paid out an acceleration. This is a 1099-LTC, and you can see that field number 2 deals with accelerated death benefit, and field number 5 asks the carrier to check at the carrier's discretion whether the accelerated death benefit is paid on account of chronic illness or terminal illness. There's spaces to put in the policy owner's name, and there's also a space for the insured's name right under field number 3. And so the IRS will, at least in theory, be put on notice if the policy owner is different from the insured. And so the IRS, if it decides to do so, will have the opportunity to argue with somebody if there's a different policy owner as opposed to the insured as to whether the acceleration is going to be income tax free. And so tax reporting is part of the process. The IRS will be put on notice, so don't think that the service won't know about these things. All right, let's go ahead and move on. Let's talk about annuities. What about annuities with enhancement features? Well, annuities aren't life insurance. We know annuity death benefits are not income tax free, and so acceleration of death benefit treatment there doesn't really help us. So we've got to look to other code sections and other rules. And the general rule is that a four-charge rider that reimburses for long-term care or pays a per diem benefit that's triggered by chronic illness should be income tax free under Code Section 7702B, which is a section that deals with qualified long-term care riders. And if Code Section 7702B, subsection E, talks specifically about treatment of coverage that's part of a life insurance or annuity contract. And basically what it says is that the portion that provides for long-term care coverage is treated as qualified coverage if it meets the standards, and the benefit is going to be income tax free. Interestingly, what it also says, and this leads us into the next point, is that there is no tax deduction for the premium portion paid for the rider if the rider fee is paid for out of the cash value of either the life policy or the annuity contract. So there's no tax deduction available under those circumstances. There's no tax deduction for the life contract available either, because of the way that life contracts work for the same thing, for the acceleration features. No tax deductions there, which is again part of subsection E, or subsection E2 on the portion that's on your screen. In general, no income tax deduction. In general, benefits paid should be income tax free under life if it's an acceleration, or under a special rider, under annuity if it's under a rider that pays for qualified long-term care expenses. If it's a different kind of configuration under annuity, benefit is probably not income tax free. So you've got to check the annuity contract or the annuity rider's language to try to figure that out. And if you've got questions about that, and if you're a client of ours, obviously we'll help you kind of sort that out. Let's talk about one other thing briefly that we've been asked about a bunch lately. Washington State has recently passed a kind of a payroll and employment tax referred to as the LTC tax, and you got to pay it unless you've already got coverage from somebody. And the question that has come up recently is, life or annuity attached chronic illness features, do they satisfy Washington State's requirements? And there isn't really a straightforward answer to that. There's a website that dodges the question in kind of a creative way. They asked, they qualify somebody who owns a life policy, for example, with an acceleration people, they qualify for the exemption to the payroll tax. It doesn't define long-term care in the actual statute in Washington State. Some people think that the folks that are tasked with implementing the tax will rely on another part of the Washington Code. And the sad story is that the other part of the Washington Code doesn't seem to definitively answer the question either, but they do seem to imply that linked benefit life and annuity products will not qualify. Now, that's going to get sorted out. That's a fancy way of us saying we don't know the answer to the question as to whether or not these kinds of acceleration features or rider features will or will not satisfy Washington State's requirements to avoid the long-term care tax. So there you go. Long-winded way of saying that we don't know. So in any event, so that's what's going on there. So in conclusion, let me wrap this up. First of all, main point is that life policy accelerations for chronic or terminal illness are often tax-free. That adds value to those products, makes them more attractive, and I think a lot of you on the call have already figured that out. There are some exceptions, some uncertainties. Third-party ownership is in a family is certainly an uncertainty. Exception for business-owned life policies Under those circumstances, the accelerations are going to be taxable. Critical illness is also going to be tax-free under a different code section, section 104, as we discussed. And, you know, I think at the end of the day, it's important to know the contract language, particularly for annuities, and, you know, how that might affect the taxation and the relevant code provisions. And again, if you're a client of ours and you're unsure about how it's going to work out in a particular situation, give us a yell. We'll help you guess based on what you got. So I'd like to thank you again for joining us today. At this point, I will turn the program back over to Jennifer, who will wrap it up. Jennifer?
Thanks, Linus, and thanks again for joining us today. And don't forget to join us next month on July 7th for the C Corporation Tax Advantage webinar. If you would like to receive materials supporting today's presentation, or if you have questions about today's content, email us at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You can view today's webinar and all of our past webinars on our YouTube channel. If you subscribe to our YouTube channel, you'll get alerted when new content is posted. Finally, if you'd like more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.